In this week's video, we'll show why the stock bulls are still in control, but their margin for error is getting smaller. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll start this week's video with the concern, which is a familiar concern when you're in a trading range and it's slowing momentum. Regular viewers, please bear with me as I describe these simple concepts, and we'll use them throughout the whole video. These are weekly charts. We use the moving averages to help us discern between low probability periods where price is below both moving averages, blue is below red, and the slopes of both are down, and favorable periods, similar to this one in 2009, when price is above both moving averages, blue is above red, and the slopes of both are up. The present-day weekly chart looks like an EKG after heavy exercise. We've got a mixed bag here. The concerns: possible lower high, which really wouldn't be that big of a deal because we're still in a range, but still, all things being equal, if this ends up being a lower high followed by a lower low, there's no question from our probability perspective our concerns would increase. Good news, bad news. Resistance. What once was resistance may now act as support after the breakout. We held and now we're floating around that line, and for the most part we closed on it. The slowing momentum can be seen here with blue below red. However, when you're in a trading range, the market model moves to anti-whipsaw rules, meaning these shorter-term moving averages become less significant from an implementation perspective. Why? Because when you're in a trading range, the shorter the duration of your moving averages, the higher the probability of a whipsaw. So we get a bearish move here, blue below red, we're staying below, but it doesn't necessarily mean it's the end of the world. Can't ignore this though. It's telling us to keep an open mind about bearish outcomes next week. We're using the same concepts here. These are weekly charts. This one in 2007, this one in 2009. The blue moving average is still the fastest. Full bore bearish look is when price is below all the moving averages. The slopes of all of them are down, and blue is on the bottom. Full bore bullish look from a probability perspective is when the fastest moving average, blue, is on top. The slopes of all of them are up. We have no bearish moving average crossovers, and price is above all the moving averages. A common takeaway or theme for clients this week is we have to pay close attention next week, but it's not time to panic. Why? The longer term trends are still favorable. This, as of the close on June 26th, looks a lot more like this favorable period in 2009 and really doesn't look anything like these high-risk periods in 2007. If we zoom into these moving averages here, we can see the slopes of all of the weekly moving averages are still up. Blue is on top and price is above all of them. Typically, it takes time to morph into a look like this or this from this or this or this, telling us that we can use support as long as we're in the trading range to try to ride this out and let the market decide. We have to respect the slowing momentum, however, and have a game plan in place if support, that we'll cover later in the video, doesn't hold. Greece has dominated the headlines over the past 3 weeks. This is the bullish long-term breakout. This is the end of 2005. Resistance for global stocks, and our bullish breakout and somewhat of a retest here. The game plan, as long as we can hold this bullish breakout, we know that the probability of good things happening from a longer-term perspective are favorable. It doesn't take a correction scenario off the table or anything like that. It's just saying, all things being equal, try to be patient as long as we hold above all of these blue lines here. Despite all the talk about the possibility, a real possibility, of Greece leaving the Eurozone. I wouldn't say that's the high probability case, but the probability for that happening is not zero, and we have to respect that. Despite all of that, global stocks were basically flat over the past 5 trading sessions. You can see it was down 0.04%. So let's just call it flat, telling us that for the most part, the market, given what they know as of the close on Friday, June 26th, is not predicting gloom and doom next week. We also know that this chart will adjust itself if the inputs or the news from Greece change. So as always, we have to keep a flexible, unbiased, and open mind heading into next week. Similar situation if we look at the United States in isolation. This is a weekly chart of the broad NYSE Composite Stock Index. Despite all the uncertainty across the pond, it actually ticked up fractionally over the past 5 trading sessions. As it stands now, the bullish breakouts are holding. Our concerns would increase significantly if price moves into this area here. Sometimes we can pick up good information or bearish information from a failed breakout. These are the charts that we looked at last week. 2007, we get our discernible lower high in small caps relative to this high, and then a lower low. These are yellow flags. Last week, we showed we had a bullish breakout. What is this chart telling us today? It's a mixed bag. Obviously, we came back down. That's the bad news. The good news is this may be a normal retest. You can see we closed right here, which is basically on this blue dotted line. And we also have the other blue dotted line. Our concerns about small caps in the market in general would increase if we closed down below the lines, and more importantly, if we break this trend line here on the Russell 2000 small cap index. Right now, this is telling us to be patient and see what type of resolution we get on this chart. Remember last week we talked about a bullish breakout in healthcare, and we also talked about the weak intermediate term trend in healthcare stocks in 2007. Look at the slope of the 50, slope of the 50, slope of the 50. As of the close on Friday, June 26th, A, the bullish breakout so far is holding, and B, the trend in healthcare stocks is much, much stronger in the present day than it was here, 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 or here. We'll say the info from small caps was a draw. The breakout for healthcare stocks is bullish as long as it holds. And this one, also for consumer discretionary, is still leaning bullish, especially as long as we hold above 77.38 on Friday, June 26th. We closed at 77.90. We're holding this breakout. And XLY, or the consumer discretionary ETF, was up 0.4% on Friday. Our concerns would increase if this breakout fails, especially if price gets into this area here. So either way, we'll get good information from this chart. This is bullish. This is concerning. Could we come up with a long list of things to be concerned about as of the close on Friday, June 26th? The answer, absolutely, positively yes, and we could do it fairly easily. You can always find a long list of things to be concerned about, and that's one of the reasons why we developed the market model. It helps us sort out the good versus the bad and understand the weight of the evidence from a probabilistic perspective. This is a ratio, a weekly ratio. You can think of it as risk on versus risk off. I prefer to own growth-oriented stocks relative to I prefer to own defensive-oriented bonds. Over the past 5 trading sessions, the ratio went up. We have a full-bore bullish look after an increase of 0.52% the week of June 26th. You may say this chart is skewed relative to interest rates. I would argue that it is not skewed. Interest rates are rising because the average market participant believes that the economy is improving. Interest rates are not rising because people think the U.S. government is about to default on its debt. So this is skewed by interest rates a little bit, but the reasons for the skew are good. The desire to own growth-oriented stocks or conviction is greater than the conviction to own defensive-oriented bonds. What does risk-off look like? During risk-off, it tends to be deflationary. Think of max fear. Bonds outperform stocks after the dot-com bust and in the financial crisis. For example, the same exact ratio using the exact same moving averages on the same weekly time frame, instead of the ratio making a new higher high this week, it made a discernible lower high as the stock market made a higher high in October of 2007. This is what risk on looks like. This and this is what risk off looks like. Is it possible that we have problems in Greece next week and this morphs into something like this? It is possible, and that's why we have to keep a flexible, unbiased, and open mind. If we want to look at both extremes, and in this case we're flipping the ratio upside down, this is 2008 here. This is what maximum fear looks like. The conviction to own conservative bonds is much greater than the conviction to own growth-oriented stocks. Full-bore bullish look in favor of bonds. This is fear, and this is what confidence looks like. How does the exact same chart look today? We already know the answer, and it's much better. This, as of the close on June 26th, still looks a lot more like this than this. As regular viewers know, there's no such thing as a magical moving average or a magical risk-on, risk-off ratio. There are a lot of things that help, and hence the market model is broadly diversified. This is another set of weekly moving averages. We said earlier that momentum was concerning. The question is how concerning? This is more concerning here. We have a bearish moving average crossover, and we actually get blue on the bottom. Then as the stock market peaks, we get a lower high in the moving average here, the blue moving average. And here, this is very concerning, very, very concerning here. Slopes are all down. The fastest moving average is on the bottom. How does the present day compare to these high-risk periods or yellow flags that we're looking at here from 2007? The answer is much better. Here in November of 2007, so before all the disasters begin, notice blue is on the bottom and the slopes of all of the moving averages are down. We don't have anything like that today. The slope of this is rolled over, but that's the least significant. It is significant, but we don't have any crossovers here, and for the most part, the majority of these averages are still sloping upward. You can see our slowing momentum here, which is concerning, but we're not in a high-risk run for the exits in anticipation of something bad happening mode. These charts are telling us that we can be patient from a probability perspective because it typically takes time to morph into a look like this from a look like this. Back on May 29th, we noted 3 levels that are what I call try to leave it alone above these levels. 2064, 2067, 2039. The low this week was 2095, meaning it was nowhere near any of these our concerns would increase levels. It doesn't tell us anything about what will happen next week. For now, support, 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 support in the general area, support, support. This upward sloping trend channel can help us try to be patient. Each break of these lines here, pink, blue, orange, and if we extend green, each successive break would mean that our concerns would increase. We won't anticipate what will happen next week. Go into next week with a flexible, unbiased and open mind because we don't need to know what's going to happen. We've had several periods of weakness over the past few months, and yet price thus far has not broken down. And we know this with 100% certainty. If we're going to go into a 3-month correction or a 3-year bear market, we can't do either of those until we break 2067, 2064, and 2039 on a closing basis on the S&P 500. That does not mean if we break these levels that we're declaring Armageddon and it's time to put canned goods in the basement. They're just simply guideposts to use to try to be patient and stay with what is still a bullish and upward sloping trend channel. Like all of the other charts we have shown, our concerns would increase if price moves into this area here next week. There's no question that the longer you stay in a range, the weaker momentum and the more vulnerable the market becomes. However, how weak is momentum relative to high-risk periods? This is the S&P 500 in 2007. We've looked at it before. We're using simple moving averages, the 50 and the 200. There's nothing magical about them. We can use them for illustrative purposes. Here, blue goes below red, and red, the 200-day, flattens out when the S&P 500 is at 1496 in December of 2007. Greece is an issue. Europe is an issue in 2011. We get our discernible lower high. The slope of the 50-day rolls over. Price goes below it, blue below red, and the 200-day is flattening out here, telling us that the long-term trend, as it was here, is becoming more vulnerable. This is a concerning look. This is a concerning look. This is a concerning look. This is a very concerning look. How do the same moving averages look today? The answer is much better from a long-term perspective. However, we have a flat 50-day here and price below it. It's not a red flag, but it is a pay more attention setup here. And with Greece having a lot of uncertainty, it's wise to go into next week with some contingency plans that say it's possible support could break. It's also possible that we break out to the upside. No bias relative to what will happen next. Our decisions with the model are made based on observable evidence. The observable evidence as of the close on Friday, June 26th, is looking more vulnerable, but it doesn't look that bad. The slope for the most part of this is still trending up. The 200-day here looks infinitely better than it does here or here. Keep an open mind, but this doesn't look that bad right now. More vulnerable, it does. The market model also looks at monthly trends. There's nothing magical about these exponential moving averages. They're used in the model, but they don't carry a particularly heavy weight, and other ones are used as well. This is the S&P 500 monthly. This is the year 2000, and you can see we get a bearish cross here. Blue goes below red, and we have a full bore bearish look here in the year 2000 before the big plunge in equity prices. How do the exact same moving averages look on the exact same scale today? The answer is much better. We still have a full bore bullish look. What does this tell us? It tells us that the next bout of weakness in the stock market from a probability perspective most likely would be a correction, or we would get some type of downdraft and a retest and then go down again. Anything can happen, but this is a relatively strong trend telling us that as long as support holds, this also says try to be patient. Price, the hard facts, and the charts, the moving averages all of it will guide us. Our game plan is to take it day by day and see how it unfolds. Because as we noted on Twitter, years of experience tells us that decisions based on facts have higher odds of success than those based on anticipation, forecasting, or fear of what may happen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.